Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, July 27, 2010. Let's begin today's broadcast by taking a look at a crop of U.S. fundamentals that came out in the New York session. First up, the S&P Case-Shiller House Price Index showed that housing prices climbed in May, but there are concerns that seasonal factors and the residual influence of the government's home buyers tax credit are boosting the numbers prior to a fall-off in the second half of the year. For instance, demand for homes have fallen sharply recently, and with inventories remaining at elevated levels, that will put pressure on housing prices going forward. Still, it was the second monthly increases in prices as the 10-city index rose 1.2% compared with April, and the 20-city index rose 1.3% month over month. Adjusted for seasonal factors, both increased 0.5%. From a year earlier, the 20-city index was up 4.6% and the 10-city up 5.4%, both better than forecast. However, the positive housing price data was overshadowed by a weak consumer confidence report, as we saw the Conference Board measure of consumer confidence dip in July over worries about the jobs picture and over income prospects. The overall consumer confidence index slipped to 50.4 in July from an upwardly revised 53.3 in June, which was initially 52.9 and is now at a 5-month low. Analysts had projected a reading of around 51.3. The latest decrease was led by a drop in future expectations to 66.6 from 72.7 in June, but the present situation sub-index also declined to 26.1 from 26.8. A third release, the Richmond Fed Manufacturing Index slipped to 16 in July from 23 in June. The report said employment continued to grow at a modest rate, with the index rising to 15 from 9, while shipments and new orders grew at a rate below June's pace. Most other indicators also suggested slower growth, the report said, and the Richmond Fed's report echoes those of other regional Fed banks that show local business activity slowing. So that was the data in the New York session, but prior to that, we did have some strong results from Europe and the UK, which helped to boost risk appetite, so let's take a look at those. First up, the ECB said that loans to the private sector rose 0.3% in June compared to a year ago. Lending to non-financial corporations was down 1.9% from a year ago after posting a year-on-year fall of 2.1% in May, saw an improvement. Loans to households, meanwhile, rose to an annual 2.8% pace, up from 2.6% in May. Mortgage lending rose at a 3.4% annual rate, up from 3.1%. All in all, the annual growth rates of private sector lending is moving in the right direction, though perhaps at a slow pace. In a second report from the ECB, we saw M3 money supply, the broadest measure of money supply in the Eurozone, and the ECB's favorite measure of near-term inflation pressures, grew 0.2% in June compared to the same month last year, which is the first positive annual reading since October. A third report from market research firm GfK showed that the forward-looking consumer climate index for Germany is set to surge to 3.9 points in August from an upwardly revised 3.6 points in July, continuing the recent string of positive reports that we've seen from the German economy. Finally, in a look at a UK release, we saw retail sales post their strongest growth in 3 years, smashing through economists' expectations. The monthly CBI Distributive Trade Survey, a reading of UK retail sales balance, soared to plus 33 from negative 5 in June, the highest level since April of 2007, and as I mentioned, above the market consensus estimate. So we had some very positive reports coming out overnight from the Eurozone and UK, and then some not so great reports from the US in the New York trading, so let's see how it played out in the markets. First up, let's take a look at the pound-dollar pair, where we saw a strong move in favor of the pound following its blowout sales release as we move from the 1.5440 area all the way up to 1.5576. The report collaborates and backs up the stronger than expected reading we saw from the UK in terms of its second quarter GDP release. The pair had moved above the 1.5440, 1.5450 resistance level in yesterday's session, and then in today's trading prior to the release of that sales report, we actually retested that resistance level as support and bounced up off of it, which is a positive sign for this pair. Zooming out to a 4-hour view of this pair, we see that we have cleared the highs we had set in April, and if the pound manages to hold on to these gains and stay above its recent support, then the next clear level of resistance, visual resistance that we see, is around the 1.58 level. So positive data and expectations of the BOE perhaps wanting to move up its timetable for raising interest rates would support the pound and give it a chance to test this 1.58 level. Taking a quick look at the pound yen pair, we also see a break of yesterday's resistance, but also this move breaks what we had seen on July 14th and also back in early June at around the 135.90 level. So this pair had been unable to break above this level for about a month and a half, but did so in today's trading as we had this very strong rise in favor of the pound. We did have a second level of resistance just above that level at around 136.50, our highs from early June. But if we manage to move above that, the next level then could be the 1.3950 level, the top of this little consolidation period we had in the middle of May. So it's pretty important to see what happens next in this pair, as we have not yet broken out of this sideways consolidation zone we've seen since the beginning of June, but we are testing the resistance and the upper boundary of that trading range. Turning now to the euro-dollar pair, it was not as fortunate as the pound-dollar, as while it did rise above its recent resistance at around the 1.30 level, it didn't manage to hold on to those gains after topping out at 1.3045 and declined back below that resistance level. So while today's high is an 11-week high for the pair, the New York session brought back some bearish leanings in the pair as we had U.S. stocks falling in the morning following the weaker U.S. consumer confidence data. That slightly worse than expected consumer data feeds into worries that a weak U.S. labor market will restrain consumer spending, considered a key driver of the U.S. economy. And as we can see, those concerns took the shine off higher yielders as we move back below this resistance level, as I mentioned. If we have a continuation of this risk aversion, then our 200 period and medium-term moving average, as well as this upward sloping level support trend line, are our next levels of support for the pair. The dollar-yen pair gained overnight and then extended its gains in New York trading, and the greenback held on to those gains despite some declines in U.S. stocks. With a higher low recently and a higher high now in this pair, looks like the greenback wants to perhaps move out of this sideways trading range we had seen over the past several sessions. After hitting a low near 86.30, it looks now that the greenback would like to recoup some of these losses it had suffered in the middle of July to the yen. This would go hand in hand with recent comments coming from Japanese officials that they would like to see a weaker yen as that helps their export sector. So we'll see if perhaps we are setting up a bit of an upward sloping channel in this pair, and so we'll have to watch that the rest of this week. We have been looking at the Australian US dollar pair recently, as it has been a very strong performer after breaking above the 0.8850 level late last week, and overnight we saw it extend its gains until it ran up against resistance at the 0.9067 level, which was close to a downward sloping level of resistance in a more medium term time frame. And from there, with the increase of risk aversion, we saw the pair most of its overnight gains, moving back down to the 0.9010 area. This could then perhaps be a prelude to the pair retracing more of its recent rally that had begun on June 18th from around the 0.8650 level, as we have some support levels, first at around 0.8960, but also perhaps we might want to retest 0.8850 and see if it can act as support. Now, while we saw the shift in risk sentiment in the Aussie pair, we saw it even more clearly in the US dollar Canadian dollar. That makes sense, since the Canadian economy is much more closely hinged to the US than Australia is. It reacts more sharply to negative news in the US, and it's also in the same time zone, so we see the effect of stocks more clearly as well. In any case, after breaking below support at 1.0280 overnight and testing the 1.0250 level, we saw the pair rebound very strongly in the New York session in favor of the greenback, moving back up above 1.0350, currently testing the 1.0360 level as of around noon New York time. that broke this downward sloping level of resistance, so that could be an indication that we may see this pair retrace further its recent move in favor of the Canadian dollar. Now, we did see commodity prices take a big hit, so that was a factor in the Canadian dollar losing, as we had oil down 2% and gold sliding around 1.8% as of noon New York time. Alright, so that's it for today's fundamental and market highlights. Let's take a look at the upcoming fundamental docket. Tonight we get a rather important release from Australia. It's Consumer Price Index for the second quarter, which could be a very strong indicator for what the RBA will do next. Following that, we get New Zealand's business confidence. Overnight, we get preliminary data from Germany on consumer prices, as well as Governor King testifying on monetary policy and financial stability before the Treasury Select Committee. Tomorrow in the US, we get the durable goods orders in the morning, which will be followed at 2 p.m. by the US Beige Book. And so that will wrap up today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.